foreigners dump South African bonds on threat of downgrade to junk. Namibia follows South Africa rate cut to boost shrinking economy. Plus, Stenob's overseas business restructured debt after scandal. Thank you for joining us and welcome to Business Incorporated. I'm Chimize Obi Iwago. We get the show started now with the markets, and after a long holiday to mark the Eid al-Kabir celebration, most major markets we track here on the African continent reopened trading today. At intraday, the Nigerian stock market was bleeding down 0.5%. The South African JSE index was down 1.53% before the release of retail sales data. The Statistics South Africa will publish the June retail sales later today. And first trading day in Egypt was quite bullish as the EGX 30 index was up 2.23% at intraday. And then Kenya resumed trading on Tuesday and was up 0.36%. And most major Gulf markets traded in negative territory at intraday after the Eid holiday. In Abu Dhabi, the index was down 0.85%, with Emirates Telecommunications Group rising 0.7%. Dubai's index was down 0.22%. Looking in Qatar, the index shed 1.62%, while Saudi Arabia's stock market is to resume trading on Sunday after its Eid break. In Europe, stocks traded lower in early trade as weak German and Eurozone GDP data reversed the previous session's rally on the back of U.S. President Donald Trump's delay to further tariffs on Chinese imports. Well, Annette will break all of these down for us. Hello, Annette. Good afternoon.
Hi. Hello, good afternoon.
Good afternoon. Well, Germany's GDP contracted in the second quarter. Now, is Germany at risk of a recession?
Yes, Germany is at risk of a recession. We have seen a contraction in the second quarter that was widely expected. So the German economic activity shrunk by 0.1% in the last quarter. And that is mainly on weaker exports. So less machinery, capital goods could leave Germany in the last quarter because global demand was actually not very high. Probably especially in China and also in the United States, most likely, but we don't know yet the details. The details will come a little bit later during the course of this month. What we know is that a stabilizing factor to German economic activity is actually still the consumer and also the government, which added more investments in the second quarter. But the weakness lies in the industrial space. Automotive is going very weak, and that's a major concern. Economists do think that Germany will also have a very weak third quarter because the parameters or the factors why Germany is so weak will not go away all of a sudden. So we have the trade war looming about over economic activity globally. Investments are companies are holding back investments because of the uncertainty, and that is affecting mainly those products Germany is producing. And then at the same time, we have Brexit. A hard Brexit is more or less given if you look at the UK and the rhetoric coming out of the new government under Boris Johnson. And on top of that, we have home-made problems like the automotive industry, which is in a very weak state because of all the challenges they are facing.
And weak data from China also adds pressure in form of industrial production, right?
Yes, indeed. Industrial production in China came in a lot weaker than expected, and that also means that if you expand that into a GDP figure estimate, that also the 6.5% of Chinese growth, which is like what they're aiming for, at least the middle of the range, can't be achieved without industrial production. And that's the same, sort of the other side of the medal in a way, because clearly Germany is weak, but also China is weak. And if China has less industrial production, they also are going to invest less. So this is like a domino effect across the world, and that was triggered by the trade war and all the tariffs, because nobody knows how lucrative it's going to be to actually sell your goods abroad or not. With the looming tariffs kicking in September, some goods are exempt now, but still overall the atmosphere is against trade, and that is hindering investments.
And Hong Kong protests also have an effect on market now. Is there a risk for a major sell-off?
There is a risk for a major sell-off if you look at the recent news coming out of today that China at least thinking about intervening in Hong Kong, according to reports. That's a major escalation for Hong Kong. So for now, the Hang Seng is the only share index in the industrialized world which moved into a negative territory year to date, and that tells you the whole story. The more the protests, or the longer the protests are going on, the more they will also factor in the earnings of corporates, and the more it will cost corporates in Hong Kong. For example, Cathay Pacific, their flagship carrier, is one good example. The stock is down by more than 7% only this week. And also going forward, they will have a lot of costs attached to those protests because they can't fly and they have all the fleet grounded, more or less. And then we have another sector, the retailers in Hong Kong. They are so much dependent on Chinese tourists coming into the city and spend their money that if they are not coming, they will have a huge loss in terms of lost revenues. And that is why the Hong Kong protests have also a very big economic impact on the island.
Well, Annette, it's midweek, and most of the markets that have been on holiday are back today. So let's see what the rest of the week will turn out to be. Thank you for those updates, and enjoy the rest of the day.
Thank you.